Good morning and welcome to Tuesday's Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormuz Fatakia, and it's a subdued Tuesday morning. The Nifty, Sensex down close to about 0.9%. The Nifty is at that 24,773. The Sensex is at 81,400 after declining nearly about 800 points. And for the last couple of days, we've pretty much been in this trading range. It's 25,000, 25,100 on the way up. And on the way down, it's 24,600, which is where our 20-day moving average also lies. So yesterday, markets moved up. Today, we've retreated a tad bit. So more than 200 points gone on the Nifty as we speak.
Speaking of the Nifty, we'll be looking for some supports at lower levels. When we had that dip last week, we had convincingly managed to defend that 24,500 mark on the downside. So that is one level that the bulls will be eyeing as of now and would be aiming for some recovery from lower levels. Mind you, today is the monthly expiry of the Sensex contracts as well. So that could result in some more volatility in the second half of the trading session. So we need to keep that in mind as well. The broader markets, though, have seen some recovery from the lower levels, be it the mid-cap index and be it the small-cap index as well. The mid-cap index has now almost turned into the green. It opened higher, then fell to the lows of the day, now heading back into the green. The small-cap index had a brief dip into the red, but still holding on to gains above the flat line as we speak. So good going for the broader markets as of now. But of course, there are a lot of earnings reactions in today's session. Bayer Crop is one of them. Strong earnings performance, 10.5% higher for that stock, remains the top gainer on the Nifty 500. Schneider Electric is the other one, 8% higher on that stock as well. So good going for a lot of these MNC names that have done well for themselves. And GE Vernova was up 10% in yesterday's session, building onto those gains, another 6% higher in today's session as well. But starting off with some more earnings reactions on the show, then PTC India, and that stock is under pressure following its fourth quarter results, and the profits were higher on account of an exceptional gain which came as a result of divestment of their wholly owned subsidiary PTC Energy to ONGC Green. The margins, though, remain flat. Now Manoj Jawahar, who is the chairman and managing director of the company, he is joining us on the show to discuss the road ahead for the company. Mr. Jawahar, good morning, sir. Thank you for joining in. I'd like to first start off by asking you about your consolidated top line, sir, for the fourth quarter. It saw a decline. What do you attribute that to, and what are the growth targets that you have penciled in for FY26 on both the revenue as well as the margin front?
Good morning, Harmesh. Good morning, Reema. Number one, our top line, it may look as if we have, it has come down, but for us, the top line does not matter like that. For us, the margin on the trading matters. So, because the top line goes up or down as per the vagaries of the weather. Since the weather has been benign, the prices on the stock, on the markets, energy markets were low. So our top line might look like as if that we have slipped, but basically we have grown our operating income by 17%. So 17% is a good number given the market situation and dynamics, and we hope to continue this momentum.
Mr. Jawahar, morning. This is Reema here. What would the numbers look like if you adjusted for the divestment of PTC Energy India, your renewable arm? So if you strip that out, then what would the numbers look like? And then if you could tell us about the realization, because you're saying that's the metric that really matters.
Yeah, so if we remove the extraordinary item also, then our operating income has grown by 17%, which is a good number, I would say. Our total MU sold volume has increased by 11%. Our operating margin has also grown by 11%. There is a little bit of dip in the surcharge income, but that surcharge also, dip in surcharge income indicates better management of outstanding position against the debtors. So I think that is a good number, not a bad number.
Okay, so can you give us some guidance on volumes and on realizations, your core your core margins for FY26?
Actually, we aim to achieve at least 10% growth over the previous number. We have been able to close this year by around 83 billion units. So we would like to achieve at least 10% growth in the margin in next year also. This year we have been able to achieve 11% growth.
Mr. Jawahar, if you could split for us the market growth as well, where it comes to short term or the bilaterals. Now, is the industry seeing a shift towards the bilateral segment? And if so, is it impacting volumes in the short term?
You see, actually, I mean, the short-term market also consists of power traded on the stock on the power exchanges as well as the bilateral trade. So, I mean, bilateral trade also includes short-term trading. But yes, the margin and the market is definitely shifting more towards the exchanges, particularly in the short-term realm. Long-term and medium-term definitely remains bilateral affairs.
Sir, it's been 2.5 years since that report, discussion paper on market coupling was released. Where are we on that right now? What is the latest update that you can share? And are we likely to hear any final guidelines on this?
Actually, I mean, that is a matter of policy, and a call has to be taken by the government and the regulatory authorities in this space. We have been advocating market coupling for a long period, and the obvious reason is that there should be, I mean, some competition in the uh, power exchange business, and that will lead to consolidation of the market. It will avoid the fragmentation. It will, I mean, lead to one country, one market, one price of electricity, and a host of other benefits. But really, I cannot comment as to when the government would be able to take a call.
Mr. Jhawar, your revenues from the HPX stood at around about 6.5 crores in the third quarter. What are the trends that you have seen in the fourth quarter, and what do you expect that to be in the new year as well? And if you could shed some light on that.
You see, actually, Hindustan Power Exchange is a power exchange. It has been struggling to get the volumes in the RTM segment and the day-ahead market segment, which is the collective segment. The reason are obvious that the incumbent exchange would always have an edge over any other competitive environment. So other two exchanges have been struggling to get volumes in this collective segment. So unless and until there is coupling, I would really find it difficult that we will be able to get any significant growth in collective segment, which is the DEM and the RTM segment. But other than that, there has been a good growth in the 10 segment, and we hope to increase that further. So we think we will be able to grow this segment on the HPX, which is 10.
Sir, there were certain reports that 4 of the PSU shareholders, which includes NTPC, Power Grid, PFC, NHPC, they're all classified as promoters of the company. And this was reported in the Pink Paper some time back, that they all want to bring down their stake. They no longer want to be classified as promoters. They want to log out of the promoter role. Is there any truth? Have you had any conversation with any of these 4 PSUs?
Actually, I mean, it is for the promoters to take a call as to what suits them. But for me, and this is the communication I have been sending to my promoters also, that on a investment of about 18 crore rupees, we, during the past around 18 years, given them a dividend income of 80 crore rupees, and the share prices have gone up from 10 rupees to currently 185 rupees. So it is a good return. Their investment has yielded them good return. It is up to them as to what they want to do with the equity. But as of now, I have no official confirmation that they are planning any serious move to exit. They are still our promoter, and I hope they remain so.
All right, Mr. Jhawar, thank you so much for sparing time and joining in today. Wish you good luck for the rest of the year as well. The management there of PTC India on the road ahead for the company. Take a short break. On the other side, all things commodities with Manisha Gupta. Welcome back. Shifting focus now to the commodity space, and Manisha is now joining in to focus on another commodity that is neither here nor there in the recent times, and that's gold, Manisha.
Well, yes, but you can't say here and there because it's trading well above $3,300 an ounce. It has seen some profit taking, yes, and that is after the EU 50% tariff put by US has been deferred from 1st of June to 9th of July. But barring that, everything else clearly has been supportive for gold. Is the reason you're looking at it trading not too far away from its all-time highs. Well, actually, Citi, as well as Bank of America, Saxo Bank, all of them who have spoken on the channel in the last couple of days do say that near-term, yes, cyclical bearishness, but structural bullishness is what they are still looking at in case of gold prices. Well, there are too many supportive factors. One, the US dollar index trading at a one-month lows below 99 has been a supportive factor. And then there are plenty geopolitical tensions as well, especially in the Middle East. The US is Also talking about more sanctions on Russia. Russia has done the biggest aerial attack till time on Ukraine, and those also have led to some premium into the markets. Having said that, it really is going to be about the US Fed meeting minutes, which get released tomorrow. Then you have the US PCE data that comes in on Friday as well. So ahead of those both important numbers, you could be looking at some choppiness into the markets, yes, but majorly 3,100 to 3,500 as the range seems to be holding now for the gold prices.
Thank you very much for that. Let's get into another corporate conversation. Sanatan Textiles reported a muted growth in Q4. EBITDA and profit declined on a year-on-year basis. Margins came under pressure. Sameer Dattani, the executive director of the company, is now with us on the show. Thank you very much, Sameer, for joining in. First, if you could explain what were the headwinds that the company faced in Q4, because of which we've seen a hit on your profitability.
No, I'll just correct you here. Our EBITDA on a quarter-on-quarter basis has improved. The Q3 EBITDA was about 58 crores, while the Q4 EBITDA is 68 crores.
And we were actually looking at it, Sameer, sorry to interrupt, on a year-on-year basis, where the revenues are down 3%, EBITDA down 13-14%, and profits down 16%.
EBITDA
year-on-year.
Yes, EBITDA on a year-on-year is also up. The EBITDA last year was 227 crores versus this year 263 crores.
But that's now talking about FY24 and FY25. We were specifically talking about Q4 versus Q4 of last year.
Okay. I think a fair way to look at it is at an annualized level, because the business will have different cycles through different quarters. But at an annualized level, we have had an improvement of EBITDA of almost 16% on a year-on-year basis. So we've had a good year, how we're looking at it, because PAT has improved and so has the EBITDA. And the last quarter, the Q4 EBITDA margin has also firmed up, showing a clear sign of better demand and firming up of margins for us.
Sameer, good morning. Thank you for joining in. So even if you take a year-on-year basis for the fourth quarter as well, the margins were slightly narrower. But even then, what are the kind of growth targets now that you are envisaging for the full year, if you want to say for the annualized basis for FY26? Have you set any top line and margin targets for the year?
So Hormas, this year we'll be starting up a new greenfield facility. It's starting up in Punjab, where we'll be more than doubling our polyester capacity. So the current revenue for this year is around 3,000 crores, whereas next year, FY26, we are estimating a revenue of between 45 to 4,800 crore rupees, because we should get about 3/4 of this new facility production.
So 45 to 4,800 crores from the current about 3,000 crores is what you're trying to say.
That's right.
For FY26, right? Okay. So now that you've gone into FY26 with the way you are with the Punjab plant, are you on track to commission it this quarter?
Yes, we're looking at commissioning in the end of June this quarter.
End of June. And how much revenue does that bring to you?
So we are hoping to get at least 3 quarters. And in terms of capacity, it's going to double our polyester capacity. Our current capacity is about 2 lakh tons, whereas the new facility will be a capacity of 250,000 tons on an annualized level. And we will, current revenue for this is 3,000 crores. And from the new facility for the first year, since we won't get the full year, we are hoping to add revenue of at least 1,500 to 1,800 crores.
So organic growth, if you strip out the extra capacity which is coming on stream, what would the organic growth look like? And what about the margins, from the new facility and on a consolidated basis? How should we look at that for the full year?
So as far as the current facility is concerned, we are sweating our asset fully. So at the current facility level, I think 3,000 crores is the fair expected revenue that we can look at on a year-on-year basis, maybe a % here or there. Because in manufacturing, honestly, the amount of capacity that you have does determine your revenue. And we've been using our capacity consistently over the last 3-4 years at more than 95-96% capacity utilization. As far as the new facility is concerned, we are definitely seeing an improvement of margins. We have a lower OPEX cost, plus we're going closer to the customer. So we hope to be the preferred choice of supplier for our customers in North India, who we've been dealing it for more than a decade now. And lower OPEX costs and some other benefits that we have there should add to our EBITDA margins.
Right. Sameer, the last time you spoke to us in April, you had mentioned that demand in India has been fairly robust over the last 2 quarters. Has that continued in this quarter as well? And you had also mentioned that you're looking to increase your share of exports. Does that happen this year from 5%, say, to around 7 to 8%?
So the demand has been robust, and that's very visible in our EBITDA margins. The EBITDA margin in Q3 was about 7.8%, whereas in Q4 it's firmed up to 9.2%. And with the same kind of revenue, the increase of margins is only because of the robust demand. As far as exports is concerned, we are surely seeing a lot of tailwinds, with the FTA that we have with the United Kingdom. Also, all the tariff advantage that the textile industry is seeing between US and India should help improve exports in the coming year for sure.
Do you think margins, Samir, can hit double digit this year?
Yes, we are very hopeful to have double-digit margin this year. Yes, we are quite there, close to 9.2.
You're close, yeah.
In the last quarter, so we are very hopeful.
And what about debt? Samir, you had mentioned that once all the plants and the repayments and all of that is done, your debt will stand at around 1,100 crores. Do you expect to bring that down further into FY26 as the year ends?
No, FY26 we won't be able to bring it down. We will be in the range of 1,100, 1,200 crores. But moving ahead with the repayments that are scheduled, we should be lowering it in the years to come.
So in FY27, where do you see that number?
I think at about 1,900 to 1,000 crores. Our peak debt should be around 1,200, which will be more towards this year and the beginning of next year.
All right, Samir, thank you so much for sparing time joining us today. Wish you good luck for the rest of the year as well. Management there of Sanatan Textiles on the road ahead. Take a short break. On the other side, we discuss market technicals. Apurva Sheth of Samco Securities joins in for a quick chart check. The markets have recovered significantly from the lows of the day. Stay tuned.
Welcome back. Banks are staging quite a recovery. The Nifty Bank, which was down more than 500 points, is down about 80 odd points. There's been a swift up move in banks. Look at that. Starting about 11 o'clock. ICICI Bank trimming its losses. Axis Bank also now just down close to about 0.5%. HDFC Bank has seen buying from the lows, and that's helping the Nifty also pick up close to about 100 points from when we started the show. When we started the show, the Nifty was sub 24,800. Now it's above 24,900. And there is also contribution from other names. Pull up a Trend, for instance. Trend is up nearly about, I think 0.6% is the gain on Trend. There you have it. Reliance Industries, L&T. It's not a sharp spike as you're seeing in some of the banking names, but they are ticking higher. Apurva Sheth from Samco Securities is now with us for a quick technical check on the market. Apurva, this last hour surge in Nifty Bank, what have you made of it? Does it open up a trade? And what will the stock calls be?
So the last hour surge, I would say that doesn't open up a trade opportunity in Bank Nifty or any other indices. So for the last 1 month, most of the indices are trading range bound. So for Nifty has been trading in the range of 24,000 to 25,000. And over the last 15 days, the range has been from 24,500 to 25,000. So the index has not made any major move. And apart from that, the mid caps have bounce back. So probably a month ago, nearly 50% of the mid-cap stocks, NSE 500 stocks were trading below their 50-day moving average. Now, nearly 90% of the CNX 500 stocks are trading above their 50-day moving average. So the catch-up rally has happened, and now it seems that there should be some consolidation or correction even in the mid-caps as well. So we have been, the top two picks that we have been recommending are, one is a short trade. So first is Ambuja Cement. Would like to go short on the stock with a stop loss of 575 with a target of 540. And another trade will be CAMS. So CAMS will be a long trade with a stop loss of 3850 and a target of 4200 and 4400.
Apurva, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. There's a commonality in these charts that you just mentioned. All of them have seen a spike towards starting 11 o'clock and then have seen a bit of a consolidation. See the Nifty as well. The Nifty Bank has had a similar spike. Reliance Industries has seen a similar spike. And most of these large banks who had seen, whose charts Rima spoke of, be it ICICI, be it HDFC, all of them have seen a similar spike towards that 11 o'clock mark and have continued to move higher from those levels. The Nifty now almost in the green, nearing that mark of 24,900 as we speak. So good recovery seen on the index. Take a short break, but just as we do that, we are excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing to you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. You can tune in to CNBC TV18 Prime at 12 noon for the global reset and for the global lens at 8:30 p.m. Into the green is the Nifty as we speak, back above the mark of 25,000. So a swift recovery seen on the benchmark index in the last 30 minutes. And onto a CNBC TV18 exclusive now. GQG's Rajiv Jain remains overweight on India. He spoke to CNBC TV18's Prashant Nair about the latest India bets and where they see value in the Indian stock markets. Here's a slice of that conversation.
Already this year, this calendar year, put in about $2 billion new money to work in India, right?
Yes, yes.
Just to sort of, for our viewers, you've bought into Bharti in a big way. I think that's a newer bet, Rajiv. And I think one name which we discussed in a very different context the last time we spoke, HDFC Bank. I remember you telling me that you've been, you held that stock for years. I mean, long back. And then, of course, you didn't own it for a long period of time. You didn't have it last year. This is, in that sense, a new addition. You want to talk to us about that, Rajiv?
Yes, so HDFC Bank, we thought was going through a sort of integration transition period as such between the two, HDFC and HDFC Bank. So since last September or thereabouts, last quarter last year till first quarter, we put almost $2 billion in HDFC Bank. And Bharti we started buying early last year, and then we have doubled down again this year. We've added a little bit to some of the other names too. Nothing meaningful, but they're like a few $100 million here and there. Nothing meaningful. So these are the two big positions. The other ones we quite like. I mean, you have public information on that. So because we're still very bullish on the utilities / infra type assets, we still like real estate. So and what's interesting we feel this time around is that seems like. And for good reason, the rally seems to be led far more by large cap than mid cap. Mid cap are fine, but the valuation is less supported than a large cap. And large caps are now transitioning from, they've digested, last few years for different reasons. And a couple other names, by the way, we just started, we recently initiated, so we are active, we can't talk about those. Again, large cap. So we feel that the large cap space looks fairly interesting, actually.
And the way the portfolio here in India is constructed, it's still, I mean, the trust is still industrials, infrastructure. I mean, if you were to sort of look at it by weightage, would that be correct?
Yeah, so if you look at it, it's not exactly precise, but banks is a big exposure, as you know, with now 3, ICICI, HDFC, and State Bank of India, so all 3, they're pretty meaningful. And then you get the infrastructure / utilities, because one thing I found fascinating is that utilities globally tend to be defensive. For some reason, these stocks are less defensive. I mean, I don't know why, but they're less defensive in India, but they have far more predictable growth because the rollout is happening. And that's probably half of our book. When I say utilities, infra combined. And then you get then you get 2 staples. I mean, ITC and Patanjali, right. And then rest is sort of, mixed match of some smaller positions.
Your thoughts on IT services and pharma?
So IT services has been in a crosshair, nothing to do with tariff, but much more around just the natural cycle, because there was a big ramp up during COVID. And which is why we have been cautious that we thought that the markets were too optimistic. And not just, when I say this, by the way, it's not just Indian IT service, I'm talking global IT services space as such. And there was a lull, and you're still sort of digesting the spike of growth that you saw during COVID and just after COVID. But thereafter, the AI-led, there's a fear of disruption AI, which has sort of impacted multiples, particularly last few months, last 6-9 months. And recently, I would say the tariff fear has impacted some of these names. But I think if you look at historically, changing technology creates more friction, and IT services has been a winner, not loser. So I think the outlook is far less worse. We don't have exposure, by the way, just to be clear, but the outlook, we were fairly cautious maybe 2.5 years ago in this space, but I think the outlook is improving because there's far more pessimism. Numbers have come off now, but the disruption risk is what people are fearful of, and that's a call you have to make, whether they'll be disrupted or not. The pharma side,
yes.
Look, pharma side, I think it's very name by name. I think US, a lot of the generic stuff will not shift to US, but there will be some shifted. Like Novartis has already announced that they will manufacture within 5 years. 100% of the needs would be met by manufacturing in US. Okay, but then they're still going to have stuff for other countries produced for other markets. But that's one company. So we feel that some companies would be winners still in this environment because, as you said, the cost difference is still enormous. We do have one exposure, Sun Pharma, which we own for a long time now, and look, we haven't done anything. So we feel that I think it's wait and watch.
I got that. You know, the other space which has attracted a lot of attention lately is defense. And it's a relatively newer sector in that sense. Lots of companies now listed. And global defense spending is at an all-time high. I think as that Stockholm Peace report, I mean, the report which came out a few weeks ago showed. In India here, of course, there's a lot of focus on, making in India what we were importing so far. And there are targets for 2028, 2030. Have you looked at the space, Rajiv?
Look, we looked at the space we used to own before years ago, but I mean, look, we've completely missed it. And I think the recent events in the India-Pakistan, I think the defense industry has a tremendous headroom. So one cannot be but bullish. Our issue is that we tend to be conservative, so the valuation and so on and so forth. But if you take a 5-10 year view, there's tremendous headroom.
And you can catch excerpts of this conversation with Rajiv Jain all day today on CNBC-TV18. Okay, the Nifty is back in the green, as we pointed out, and above the 25,000 mark. One level to watch will be yesterday's intraday high, which is 25,079. The Nifty is now flitting between the red and the green line, but there's been a remarkable more than 200-point recovery from the lows. It's been a swift recovery just in the last 30 minutes or so from about 11 o'clock. 25,079 would be yesterday's high, will be the immediate hurdle for the markets to cross. And remember, it's also the expiry. Get into a break. On the other side, market fundamentals with Jyoti Vardhan Jaipuria from Valentis Advisors joins in.
Welcome back. Now, as India electrifies faster than ever, from AI-ready data centers to renewable energy and industrial expansion, the demand for transformers is surging. But can supply keep up? Or are we looking at a bottleneck in one of the most crucial links of the power chain? Vamakshi is here with more details on this.
Transformers are the real power players, crucial component of our electricity grid who ensures that power is transmitted at just the right strength. No surprise then that the transformer market for Indian players is expected to grow at a CAGR of 23% to 39,000 crore rupees by FY27, driven by 16% CAGR in the domestic market and a massive 42% CAGR in exports. But here's the problem. With demand growing so rapidly, supply is struggling to catch up. Why is that so? It is on account of a few factors, which includes the shortage of critical raw materials and lack of manufacturing capacity.
There is a huge shortage in the extra high voltage transformers because some manufacturing capacities are not there, and other than that, there are a lot of hindrances, or there are a lot of issues with raw material that has to be fed to these transformer factories. So raw material is becoming a larger issue than manufacturing capacities of the transformer manufacturers. Raw materials that are in shortage are CRGO, which is not made in India. Then copper is an issue. Copper in terms of specifically CTC wires that are used in a transformer or a reactor.
So how bad is this shortage? Well, experts believe the demand-supply mismatch is severe and is here to stay. Lead times have been stretched, especially in the global markets, where there is as much as a 3-year wait period.
If I say about our EHV transformers, our manufacturing capacity for EHV transformers is close to about 17 transformers a month. And I am only able to manufacture, let's say, 11 to 12 transformers a month. And this is because of the short supply of raw material to T&R. We have been trying, but if you look at it globally, nobody has expanded, neither the RIP bushing manufacturers, neither the CTC manufacturers, nobody has expanded. They didn't foresee this kind of need for transformers. CRGO, we are also having an issue because a lot of the CRGO is also going into motor building for electric cars.
What industry participants have been forecasting is close to about 20-25% mismatches in demand supply between transformer capacities and demand as on date. And this is after pricing and moderation in demand coming in from the short cycle industrial sector customers. Globally, export capacity and demand supply mismatches they translate into almost 3 years of wait period for transformer requirements for applications such as renewables.
Because of this demand-supply mismatch, the prices of transformers have soared, and so have the margins for most transformer players. For instance, for volt-amp transformers, the operating margin expanded from 14% in FY20 to around 18% in FY25. CG Power 2 saw its overall margin expand from 5% in FY20 to 13% in FY25. So the big question is, for how long will this demand-supply gap persist? How long can these high margins sustain? Well, the demand-supply gap should ideally start narrowing as the raw material shortage gets addressed and as companies ramp up their manufacturing capabilities.
It will narrow down. It will help Indian manufacturers a lot in terms of increasing their capacity.
Okay.
There is going to be a demand-supply gap of close to about 1 lakh MVA per annum.
The next 12 months, we will slowly start to see the demand-supply equation evening out. Until then, companies will continue to enjoy better margins in this business.
As far as valuations are concerned, most companies have seen their multiples come off from recent highs seen in 2024 on account of slowdown in government capex accompanied with a broad-based sell-off in the market. On an average, valuations have corrected over 50% from their recent peak in the second half of 2024. But as investors, I'm sure you're asking, how much is really baked into the price and what should we buy?
Volt-amp followed by Trill is something that we look at because they are specifically manufacturing transformers, whereas Hitachi, GE, as well as Siemens, ABB, or even Schneider, to that matter, they are multi-product companies. So if one product is doing well, other product may or may not do well. That's how things would be. But the more skew would be towards names like Hitachi, GE, and Siemens Energy.
Almost everything is baked in the price. Valuations had topped up a quarter back, and definitely after the recent correction, there is some breather. Valuations continue to remain on the higher end of the band. So most transformer companies today trade still 30 times plus. From the stocks that we cover, CG Power has been among a preferred name. They are doubling capacity and looking for export market also, which was not a part of their portfolio earlier. So that is our topic in the space.
So what's the takeaway? The transformer industry is booming, but supply shortages are creating challenges. With major investments and new capacity additions, we might see some relief in 2 to 3 years. But one thing is clear, the world is electrifying and transformers will remain critical to this transformation.
Well, But after that electrifying update from Vamakshi, we'll take a short break here on Trading Hour. But just as we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is, of course, CNBC TV18's all-new app, where you get breaking news, instant articles and financial world updates right at your fingertips. You can download the app from the App Store or the Google Play Store, or even scan the QR code that comes up on your screen to download the app. Take a short break. Back on the other side. Stay tuned. Well, it is the day of expiry, so it is the day of being choppy as well. 50 points lower back on the Nifty now, below the 24,950 mark as we speak. 70 points lower now on the index, in fact. So the bounce that we saw in the last few minutes of trade is now getting sold into. It'll be interesting to see what the final tick comes up to on the index. But Jyotivardhan Jaipuria from Valentis Advisors is now joining in with his top sectoral ideas and his views on the markets as well. Jyoti, good morning. Thank you for joining in. What do you make of this earnings season so far, where if there was a lot of fear that this would also end up being as bad as the third quarter was, but it does appear to be, it may not have been as bad as what the street was fearing.
Yeah, you're right. So, we started the earnings season with very low expectations. So that was a good thing. Because the expectations were low, earnings have actually been better than what the street was expecting. And so it's not like, I would not call it a spectacular earnings season. At the same time, it's not been a disappointing earnings season. On the margin, earnings have, surprised positively. And I think, as we move into the first half of FY26, hopefully we'll see a recovery coming. And this is like the start of some earnings pullback, which we see. We are thinking FY26 should be like a 11 to 12% sort of earning growth for the year.
So far, for the companies that you track, what's been the earnings growth in Q4?
The Nifty earnings growth is roughly coming around 6%, and there's still some companies to come. Some of the small caps which we have in our portfolio, they've been growing at closer to 13%. But those are very select bunch of people, so it's not like a broad-based probably representation.
In fact, you've been advocating that even though small caps are not cheap relative to the large caps, it makes sense to buy into the correction. That's been the strategy. So today, what percentage of one's portfolio should be in small caps? And can you share some small cap ideas or themes with us?
Yeah, so Rima, it all depends on the risk appetite of the person. So, I don't want to say this is what a percentage should be. But what you have to remember is this will be a very volatile segment. It's not exactly a cheap segment even today. So it's not like you're getting in and there's blood on the street. So you should have some allocation to small cap today, because that's where I think over the next 3 years, a bigger earnings growth will come. And so over the 3 years, they'll drive it. At the same time, it will be a very volatile segment. So essentially what you should do is use dips to buy small cap rather than this. And there are like a lot of interesting opportunities we can find in the small cap, which probably, within the engineering space, there are a lot more opportunities in the small cap and the mid cap than you get really in the large cap, because there are niche engineering things right from pipes to transformers to, a lot of other smaller equipment which will do well. There are a lot of ancillaries to the consumer companies which do well, including the auto ancillaries and other people who supply to consumer companies, which you get in the small cap companies. So they trade much cheaper than what the consumer companies trade. And because they supply to not just one, but 3-4 of these larger players, then you tend to, hedge yourself against somebody gaining market share, somebody losing market share. So I think, there are a lot of niche opportunities which you get in mid and small cap, which probably are not there in the large cap, which one can look at.
If you are asked at this juncture, Jyoti, where are you going to put your money to work, where would you do so? And are there specific segments that you would want to avoid at this point of time?
For us, it is where is the risk, where's the reward, and essentially where is too much optimism. We tend to be very, very value conscious. So for us, banks has been one area which we have been investing in, and we continue to invest and like in the space. The other area which we've been nibbling at is the cement sector. Seasonally, they don't do well in the monsoon. So that's really the time to build your position in the cement sector. We think once the monsoons goes away, then probably, cement prices will go up. And the sector's got consolidated quite a bit. The third area we've been focusing a bit on has been the chemical space. So chemicals is something which has got beaten down a lot. The way we see the macro, there was a lot of destocking happening from at the dealer level. That destocking is now behind us. And so we think that cement volumes will start to pick up and the pricing environment will remain more stable. It's a sector which is still not very, very cheap, but here there are a lot of niche and especially more mid-cap and small-cap companies which have a niche segment where, there's volume growth which is coming and there's pricing environment which is turning better. So these are three segments we are looking at. We continue to like the pharma segment, though, there's some concern on what the US does, what Trump does on the tariffs over there. But that's a segment, again, on every dip which we want to really participate in.
In pharma, would you go with CDMO? That seems to be the favorite now for most.
Yeah, so, we've been very early in the CDMO. We continue to like it. Valuations are no longer cheap over there. But I think, the growth is going to be really tremendous. So probably, most companies in the CDMO will probably double earnings over the next 3 years, unless something really changes on that pharma environment in the US, where, a lot of tariffs come or they put some trade barriers. Otherwise, I think, most companies will probably at least double earnings over the next 3 years. So you have to buy that growth and we continue to like it.
You mentioned metals in one of your previous answers, Jyoti. There has been fair amount of resilience that China has shown despite the tariffs that have been imposed by the US administration. The industrial profit data that came in this morning was fairly good. Does metals remain a tactical play here? Because there are too many moving parts surrounding the global economy here. So do you stay with this as a tactical play or do you still find value here?
No, so see, metals, frankly, cement is the place we like, which is more domestic. Metals is very global. So for us, the worry is that the global environment is not great and, global economy is probably going to slow down this year. So to that extent, we are not very excited about metal as a space. There will be tactical opportunities here because, these things really move quite a bit. So anytime that China really starts to show some growth in the economy, there'll be some tactical plays. But otherwise, metals are something which we generally avoid as a house. We don't really participate in it too much unless we get it at really beaten down valuations, in which case, we think it's good to buy and hold till the cycle, starts to do well.
One final question from my end, Jyoti. You mentioned banks as well, right? But just before I get to that, there have been two themes that have been at the talking point in the recent past. Defense has been one of them. And in line with defense, railway stocks have also moved higher after seeing the kind of correction that they had. So a lot of these defense names are at record highs again, be it the shipbuilding companies or names like HAL, which is not at a record high but has recovered substantially from the lows. What do you do in spaces like defense and in railways as well?
So, defense is something which over the course of next 5 years, 10 years, probably all these companies will become much bigger than where they are today. But, given where the current valuation is and given the optimism today is something which, does not fit in our framework. At these valuations, we don't feel comfortable buying it because for us, we want a margin of safety. So, if something goes wrong here, just remember there's practically one buyer only, which is the government of India. And, if orders get deferred or the implementation gets deferred or, companies take time to implement, then, you suddenly start seeing share price corrections and they can be quite volatile. So we prefer buying a lot of these when, there's less optimism around it and the valuations are a little more cheaper.
But so you mean you would wait for a correction before you buy into these defense names, right, Jyoti?
Yeah, I would wait for the correction.
All right, Jyoti, thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. Jyoti Vardhan Jaipuria there of Valentis Advisors, by the way, continues to remain as choppy can be. At one point we were down 80, now we are down 50. So the bounce, the swings continue on the index, considering the fact that it is the Sensex monthly expiry as well. Olectra Greentech, still the top loser on the Nifty 500, but 6% lower on the stock. And giving it good company is Brainbee Solutions. That too is now down 6% at the lowest point of the day. The top two losers on the Nifty 500. Sagility continues to remain in a 5% lower circuit as well. The OFS opened for non-retail investors today and will open for retail investors in tomorrow's trading session. So a lower circuit for Sagility. Take your leave on this edition of Trading Hour. From Rima, me and the team that put this show together, thank you so much for watching. Halftime report on the other side.